Are there dangers associated with infinite banking? If so, you should be made aware of them. Aloha, I'm Stan Cox, Principal Broker and Strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the Tax-Free Cash Growth Warehouse Strategy, and I'm the Managing Director of the Hawaii Financial Free Thinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and the tax-free cash growth warehouse finance strategy. Infinite banking is a rather obscure concept that was quantified in a book by R. Nelson Nash back in the 1990s. Definitely not a mainstream finance strategy, but with such an interesting and curious name, it does catch the eye and ear and imagination of those few who are not satisfied with the status quo and who go searching for something better. There is also the unfortunate fact that none of the books I've seen on the infinite banking concept and strategy explain exactly how the infinite banking accounts are to be properly designed. There's a reason for that. Most people are not life insurance producers and therefore are not even able or allowed to design an account for themselves, even if they were to be educated fully on the architecture of infinite banking account design. And therein lies the greatest danger that I can see relating to infinite banking. And this is what it is. There are unscrupulous agents who will take advantage of people if given the opportunity. And here's the thing, most life insurance agents do not know how infinite banking works and haven't got the first clue as to how to properly design an account for use of the infinite banking strategy. So, since the population in general doesn't know the requirements to putting together a properly designed account for infinite banking, and none of the books I know of try to teach the reader how infinite banking accounts are designed, this leaves open the opportunity for unscrupulous agents to take advantage of the unsuspecting client. If you read Nash's books and others about infinite banking, you will see the term paid up additions rider, which is abbreviated PUAR. And that rider is an important part of the design of an infinite banking account, but it's not the most important part. In fact, an infinite banking account may be properly designed with just a minimal PUAR or even with no PUAR at all. Adding to the problem, here is the fact that not all insurance providers call their paid up additions rider paid up additions. So what is it that you're looking for that will do what that provision does for the design of the account? I will say that the rider that increases the MEC limit and significantly adds to the cash value growth of the account is of greater importance than the PUA rider it alone is. And guess what? Nash doesn't even mention that rider in his books. Neither do any of the other books that I've seen except mine. Now, another complication with that is that not all insurance providers even offer the specific rider that accomplishes that all-important task. Already, without getting into any details, the information I have just disclosed is probably a bit confusing already. So let me back up and shed some light. MEC, MEC is an acronym that stands for Modified Endowment Contract. In the early 1980s, the IRS enacted a rule that sets the limit to the amount of cash that can be added to a life insurance contract. That limit is based on the total face value or death benefit of the policy and the premium required to pay for that particular policy. We have another video here on this channel that explains more fully what a MEC is, but basically, if a person stuffs more cash into their policy than the MEC rule limits it to, in any 1 year, the life insurance policy will become a modified endowment contract, and it will lose the IRS sanctioned benefit of growing the cash value tax-free. That's very important because the tax-free growth of cash value is one of the biggest and best advantages of the whole infinite banking strategy. So you don't want to lose that benefit. So what is the rider that raises the MEC limit and significantly increases the cash value and tax-free growth of the cash value in an infinite banking account? Again, different providers have their own name for their riders, but basically the rider is a type of term insurance, which in itself is very strange because in no other case does term insurance have any cash value at all, except when the insured person dies and the policy then is paid out to the beneficiaries. And here's how that rider works. Starting with a base whole life insurance, let's say of $100,000, then adding the term rider to it with a face value or death benefit of $200,000, together that gives the policy a total face value of $300,000. Simple math. So if based on the age and health of the insured person, a $100,000 policy whole life has a MEC limit of $10,000 per year, by adding the $200,000 of the term rider and increasing the total face value to $300,000, the MEC limit should increase to about $20,000 to $25,000 a year. Now, and I don't want to get too involved explaining this because my point is not to confuse, but rather to enlighten. If the annual premium of $100,000 of whole life for this client is at $4,000 per year, the MEC limit being at $10,000 will limit any additional cash dump in to just $6,000 more per year. But with the additional $200,000 of the term rider, the MEC limit is raised to, let's say, $22,000. Now, the $200,000 that the term rider adds to the policy has a premium of just another $4,000 per year for a total premium of $8,000 per year. So you see that the term rider gives you twice the amount of insurance for the same premium as the whole life of half the face value. So adding the term rider increases the MEC limit at a much lower cost than it would be if the whole policy was made up of just whole life. And that will now allow a dump in of up to $14,000 additional per year. Why is that so valuable? Is because, first of all, with the right provider, the $4,000 of premium for the term rider will contribute about $3,400 to the cash value starting with year one. And again, this is the only time term insurance has any cash value for the owner of the policy. Additionally, the cash value grows with compounding dividend interest. So the more you're allowed to stuff into the cash value, the faster it grows. The first year of the policy, the base whole life doesn't contribute any cash value to the policy because the entire premium is going to pay for the insurance. So the cash contributed by the term rider is a big deal. Back to the paid up additions rider. That is an optional rider that pays in full for a small amount of whole life insurance that gets added to the total face value of the policy. And that can be set at just about any amount you like up to the MEC limit for the policy. Most providers have a minimum requirement, so you can't have a PUAR that's less than usually about $300 per year. But whatever it is, the premium paid for that PUAR, most of it gets added to the cash value on top of buying a chunk of whole life insurance. It's pretty amazing, really. Think about it. You pay to buy some insurance, and the insurance company gives most of that money back to you. For example, if you have $1,000 of annual PUAR premium, it'll buy you around $3,000 of whole life insurance and put close to $900 into your cash value at the same time. Crazy, right? I got a tiny bit off track there for a minute, but it's those details that are required in constructing a proper infinite banking account that open the doors for the dangers connected to infinite banking. The bottom line is that infinite banking itself, or practicing infinite banking in the tax-free cash growth warehouse strategy, really has no dangers to be wary of. The dangers associated with infinite banking are that a person can be taken advantage of by agents who don't understand how infinite banking works or what is required for a proper account design, or they just don't care about anything but their commissions. I've seen agents tell people that universal life insurance, or IUL, is great for infinite banking. It is not. And while a straight whole life policy with no riders at all may be used for infinite banking, it will take a good while for the policy to build enough cash value to be useful for the strategy. And it will not ever be nearly as efficient in growing cash value as will a properly designed account with a mutual company that has a non-direct recognition policy for its policy loans and that pays higher dividend interest than the simple interest it charges for policy loans. Yeah, there's a lot to know. And that's why it's important to work with a trustworthy infinite banking specialist who will look out for your best interest, not one who is only concerned with making the biggest commission they can at your expense. Now, if you found this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also below. And if you'd like to apply to become a client of ours, we would encourage you to do that. The link to the application is also below. We're here to help, and we look forward to helping you. For now, aloha and mahalo for watching.